Today, we're embarking on a deep dive into the very financial bedrock of nations, how governments fund themselves. Okay, let's begin at the absolute core, taxation. When we talk about how a government funds itself, taxation is invariably the primary answer, right? It's the compulsory contribution of individuals and businesses to the government, crucial for everything from building roads to funding schools. But beyond simply being a source of cash, what are the deeper, essential functions of taxation? Why is it structured as this mandatory contribution?
That's a great question because it really does go beyond just revenue generation. While taxes are indeed the primary source of income for the government, enabling the provision of all public services, they also serve a powerful economic regulatory function. Think of it as a governmental lever. By taking more money from people through taxes, they can sort of cool down an overheated economy, reducing overall spending and potentially curbing inflation. Or, conversely, by taking less, they can inject more money into the economy, stimulating activity during a downturn.
Right, a tool for managing the economy.
Exactly. And another crucial aim, and one that's often debated, is the redistribution of wealth. Many tax systems, like the progressive income tax systems found in many countries, are designed so that higher earners contribute a larger percentage of their income. This wealth can then be used to fund services that benefit everyone, especially those who can't afford them otherwise. It aims to create a more equitable society. It's a tool for social policy as much as fiscal policy.
So it's not just about collecting money, but also economic management and social equity.
Okay. And when we consider the general characteristics of tax, two aspects really stand out, don't they? First, its compulsory nature. Payment is mandatory for all citizens and entities, and the reason for this compulsion is pretty practical, isn't it?
Absolutely. Imagine trying to charge individual users for national defense or for, the fresh air in a public park. Collective services simply cannot be delivered by charging directly. It just wouldn't work.
Yeah, that makes sense. And the second characteristic.
The second is the absence of quid pro quo, that Latin phrase, something for something.
Right, quid pro quo.
It's fundamental here. Unlike buying a product where you get a direct return, with taxation, you don't receive a specific measurable value for the individual taxes you pay. You pay income tax, and it goes into this vast pool that funds everything from parks to police without a direct transactional return for your specific payment.
Okay, I see. No direct swap. Exactly. Understanding those characteristics sets the stage for how tax is actually viewed and calculated. There are four crucial categories that provide a framework for the entire system. First, the subjects of taxation. These are the individuals or legal entities like companies who are ultimately responsible for paying the taxes. They are the who of taxation.
The who, got it.
Then we have the objects of taxation. This refers to the income, wealth, or spending power that the subjects possess, and that is being subjected to tax. It's the what is being taxed.
Paid for the what?
Next is the tax base. This is the specific portion of that income or wealth that is actually subject to taxation after any deductions or exemptions. So the initial object gets refined here.
Right, the bit they actually calculate the tax on.
Precisely. And finally, the tax rate is the tariff or percentage applied to that taxable amount. What's important here is that this rate isn't always static. It can increase based on income brackets, especially with personal income tax, reflecting those progressive systems we mentioned earlier.
That makes a lot of sense, framing the who, what, and how much. Now let's delve into some important concepts for tax calculation or determination. These are the nuances that can significantly affect what a person or company actually pays, moving beyond just the gross income. What are some of the key levers and adjustments here?
First up are deductions. These are allowable expenses like certain travel or medical expenses that are subtracted from your gross income before tax is applied, effectively reducing your taxable amount.
So they lower the income figure the tax is calculated on.
Exactly. Think of them as approved ways to lower your tax burden based on specific circumstances.
Okay. And exemptions, how are they different?
Exemptions are different, yes. These are specific types of income or entities like nonprofit organizations or even entire transactions that are simply not subject to taxation at all. For example, some government benefits or in certain countries, maybe even the salaries of heads of state might be exempt. They fall entirely outside the tax net.
Completely outside. Okay. And what about when governments want to encourage certain behaviors, like investment?
Ah, that's where incentives come in. These are a special type of exemption or tax reduction strategically designed by the government to stimulate economic activity or development. For instance, a government might offer a tax holiday, basically no tax for a few years, to a new factory. The aim is to encourage job creation and investment in a specific region.
So it's using the tax system to guide economic growth.
Precisely. It's a policy tool.
So deductions reduce taxable income, exemptions mean certain things aren't taxed at all, and incentives are like tax-based encouragements.
What about after you've paid your tax? Is there anything then?
Yes, that brings us to a rebate. A rebate is essentially a partial refund of taxes you've already paid. These are often based on specific criteria like age, maybe rebates for those over 65, or perhaps for certain educational expenses. It's a mechanism to reduce the final tax owed or to return a portion of it.
A refund, basically. Okay.
Now, here's a concept that often catches people off guard. Bracket creep and drag. Fiscal drag. Right, I've heard of this. It sounds sticky.
It can be. It's this phenomenon where inflation and higher tax rates can cause a taxpayer's net or take-home income to actually decrease, even if they get a nominal pay raise. The raise might push them into a higher tax bracket, right? And the increased taxes can outweigh the raise's purchasing power, leading to a real decrease in their net income.
So you get a raise, but end up with less buying power.
Potentially, yes. It's like running on a treadmill that's constantly speeding up. You work harder just to stay in place or even fall behind.
That sounds incredibly frustrating for taxpayers.
Mhm.
How do governments try to counter that fiscal drag?
Well, they often employ indexing. This involves linking tax rebates and, crucially, income tax brackets to inflation measures, like the Consumer Price Index or CPI. The goal is to automatically adjust these thresholds. This helps to maintain the purchasing power of taxpayers and prevent bracket creep from unfairly eroding their real income over time.
So it adjusts the goalposts, so to speak.
Exactly. It's an attempt to maintain fairness in a changing economic landscape.
Before we move on, just a quick distinction. Company types in a tax context. Domestic versus foreign.
Yes, briefly. A domestic company is one managed and controlled within a particular country, let's say South Africa. Its tax obligations are primarily governed by South African law. A foreign company, on the other hand, is managed and controlled from abroad, from another country. This distinction often impacts where and how their profits are taxed and which international tax agreements might apply.
That makes sense for understanding tax jurisdictions. Okay, good clarification. Now let's broaden our scope considerably. So within that larger picture of taxation, how do we distinguish between the different ways taxes are levied? What are the key types of taxation?
Good question. The two main distinctions are direct tax and indirect tax. Direct taxes are, well, like the name implies, imposed directly on personal or corporate income, wealth, or capital gains. Think of it as a tax you pay straight to the government based on your earnings or assets. Examples include personal income tax, company tax or corporate income tax, and payroll tax. The burden of this tax typically cannot easily be shifted to someone else.
You earn it, you pay tax on it. Seems direct enough.
Exactly. In contrast, indirect tax is levied on goods and services. These taxes are often collected by intermediaries like businesses who then pass them on to the government. You, the consumer, pay them as part of the price of the goods or services you buy.
Ah, so it's baked into the price.
Right. Prime examples are value-added tax, VAT, excise duties on specific goods like alcohol or tobacco, and customs duties on imported items. You might not see these clearly on your payslip, but you certainly feel their effect every time you make a purchase.
That distinction really clarifies who directly bears the initial burden, doesn't it? Now, you mentioned a few specific examples earlier: individual income tax, excise duties as some of the other 5 sources of government revenue. How do those fit into this direct versus indirect framework?
Oh, they fit perfectly. Individual income tax is a classic direct tax levied on personal earnings. Payroll tax is typically a direct tax too, levied on the total payroll of an organization. It's often paid by employers on behalf of their employees, and it falls under the broader income tax umbrella.
Okay.
Company tax, or corporate income tax, is also a direct tax levied directly on company profits. For instance, in a country like South Africa, the corporate tax rate currently sits around 28% for most companies.
Right, taxing profits directly.
Then excise duties are an excellent example of an indirect consumption tax. They're levied on specific goods, often those sin or luxury items.
Like cigarettes and alcohol.
Precisely. And customs duties, or import duty, are also indirect consumption taxes levied on goods brought into the country. So these specific examples really illustrate the practical application of direct and indirect taxation.
Here's where it gets really interesting, I think, as we drill down into some of the most common and important specific taxes and revenue streams. Let's make sure we truly understand their definitions and nuances. First, Could you elaborate a bit on payroll taxation and turnover taxation?
Certainly, payroll taxation is a tax on the total payroll of an organization. It's a direct tax on labor costs, essentially. Turnover taxation, on the other hand, is a tax calculated on total transactions or gross sales, not profit. It's often implemented as a simplified tax system, particularly for micro businesses, making it easier for them to comply compared to calculating complex profits.
So simply for small businesses, maybe. Okay. Shifting gears to wealth taxes, taxes related to assets. Property tax is universally recognized. What's its unique characteristic? And maybe clarify the difference between real property and personal property again.
Sure. Property tax is typically levied by local municipalities or councils based on the assessed value of a property. It's often the largest single source of income for these local governments, and importantly, usually only local governments have the authority to impose it.
So local tax for local services.
Largely, yes. Now, real property refers to immovable property that's land, plus any permanent improvements or buildings on it. Think houses, office buildings, land itself. Personal property, conversely, refers to movable goods, things like furniture, motor vehicles, maybe jewelry, or even certain business equipment. The distinction is crucial for how they are assessed and taxed, if they're taxed at all.
Got it. Immovable versus movable. What about other wealth taxes, like estate duty?
Estate duty, sometimes called death duty or succession duty, is a tax imposed on the total value of a deceased person's estate before the assets are distributed to heirs. It's a way for the state to claim a share of inherited wealth.
And when property changes hands while someone's alive, there's transfer duty.
Precisely. Transfer duty is a tax levied when a purchaser buys a property, and the title deed, the legal ownership document, is officially transferred into their name. It's important to note, though, that newly built properties, when sold for the first time by a developer, are often exempt from transfer duty because VAT would typically apply to that initial sale instead.
Okay, so you don't usually pay both on a new build. What about stamp duty?
Right. Stamp duty is a duty that used to be more common, often imposed on legal documents, contracts, agreements, bonds, things like that. It's distinct because it is not usually an ad valorem tax.
Meaning not based on the value.
Correct. Its amount isn't based on the value of the transaction itself, but often it's a fixed fee per document or type of agreement. It's less common now for many transactions. Capital gain tax, CGT, however, is very relevant. It's a tax charged on the profit or gain made from the disposal, usually selling, of an asset. This could be property, stocks, bonds, other investments. It targets the increase in wealth generated when the selling price exceeds the original purchase price after adjustments.
Yes. Taxing the profit from selling assets. Okay, that covers wealth tax as well. Let's pivot to consumption taxes. We've established consumption tax as a general term for tax applied when citizens spend money on goods. The big one here is value-added tax, or VAT. What's its mechanism, and why is it so widespread?
Value-added tax, VAT, is a very common indirect tax. It's a sales tax levied at each successive stage of the production and distribution chain, from manufacturer to wholesaler to retailer. Each business in the chain charges VAT on their sales, but crucially, can usually reclaim the VAT they paid on their own business inputs. So the tax sort of cascades through the chain.
And the final consumer pays the total accumulated VAT.
Exactly. The end consumer ultimately bears the full tax burden because they can't reclaim it. Businesses typically need to register as a VAT vendor if their turnover from taxable goods or services exceeds a certain threshold, for instance.
Okay, VAT seems central. Now, import duty. You mentioned its dual purpose earlier. Can you expand on that, particularly maybe in relation to the concept of dumping?
Sure. Import duty, or customs duty, is a tax on goods and services brought into the country. Its dual purpose is key. Yes, it generates revenue for the government, but it also acts as a protective measure. It discourages the importation of certain goods. This might be to protect nascent or established local industries from foreign competition, encourage domestic production, or even help manage a country's balance of payments.
Protecting local jobs and industries.
That's often the goal. Related to this is dumping. This is a specific and often contentious international trade issue. It occurs when an industry in one country, perhaps because it's heavily subsidized by its government, exports products to another country at a price significantly lower than the cost of production in the exporting country or lower than the price in its home market. This practice can be incredibly damaging. It can undercut and potentially force local industries in the importing country out of business, harming that economy. Import duties, or specific anti-dumping duties, can be imposed to counteract this and level the playing field.
Fascinating how taxes can be used in international trade disputes like that. What about excise duty, that?
Yes, excise duty. It's levied on specific commodities, typically tobacco, alcohol, fuel, sometimes sugary drinks or luxury goods. What's crucial and often overlooked is that it's frequently levied based on quantity, like per liter, per kilogram, or per unit, rather than being an ad valorem tax based on value.
So per bottle of wine, not based on the wine's price.
Often, yes.
That's a really interesting nuance. Thanks for highlighting that.
Look, if you're curious about how governments make decisions or how public services work, or maybe you just want a clearer picture of what shapes your community. And if this sounds like your kind of thing, if you want to explore these topics more with us, well, hitting subscribe is probably a good idea.
Definitely. Yeah, click that subscribe button. We've got plenty more planned.
And maybe give this video a like. It helps other people who are interested in this stuff find the channel.
Please do. It makes a difference.
Definitely. You can find us on social media. Just search for ConsultKano. Let us know what you think.
Yeah, drop a comment below. But until then, do check out some of the other videos.
Lots to explore. Thanks again.
Kano Consultants, for professional advice.
You can trust.